Right now, as I'm recording this, there are active wildfires burning across western and southern Colorado. One of them, the Aspen Acres fire near Colorado City, has already burned through more than 50,000 acres and destroyed close to 200 structures. Whole towns along the wet mountains have been evacuated. And here's the part most people outside Colorado don't know about yet. Insurance brokers are saying some carriers have simply stopped writing new policies within 20 to 50 miles of an active fire, not lowering coverage, not raising the price, just refusing to write the policy at all. If you own a condo in a mountain town, or you're trying to buy one, that single fact is starting to decide whether your mortgage even goes through. So let's actually walk through why this is happening, because it's not just about the fires themselves.
Before I get into it, if you're someone who's watching the Colorado housing market, or you own property anywhere near a wildfire zone, you're gonna want to see the next few updates on this. The rules are still changing month to month right now, so hit subscribe and turn on notifications if you want to catch it as it happens, because I'm gonna keep tracking this one closely. Okay, let's get into what's actually going on.
So here's the situation in plain terms. Colorado has two things happening on top of each other at the same time, and together they're squeezing condo owners in a way single-family homeowners aren't feeling nearly as much. The first thing is the state's insurance market. Colorado now has one of the largest cumulative increases in home insurance premiums of any state in the country since 2020. According to Insurify, a company that compares insurance policies, the average Colorado homeowner is paying around $4,164 a year in 2026, and for people in the highest risk areas, it's a lot more than that. There's a homeowner in Parker whose premium has quintupled over the last decade to about $4,700 a year, and that's just for a regular single-family home, not even a high-risk mountain property. The second thing is what's happening on the lending side. Earlier this year, Fannie Mae and Freddie Mac, the two companies that back the vast majority of U.S. mortgages, tightened the insurance rules condo buildings have to meet before a bank can sell that loan to them. So now you've got insurance getting harder to buy at the exact same time the mortgage rules are demanding more of it.
Let's talk about the law first, because this is the piece that's actually new as of this month. It's called House Bill 25-1182. Colorado's governor signed it back in May of 2025, and it officially took effect on July 1st, 2026. So it's only been active for about 3 weeks as I'm recording this. What it does is pretty simple to explain. For years, insurance companies use their own internal wildfire risk models to decide your premium, and homeowners had no way to see the number or challenge it. This law forces insurers to give you a plain language explanation of your wildfire risk score, and it gives you a formal process to appeal it if you think it's wrong. Colorado's insurance commissioner, Michael Conway, has pointed out something important here. This law doesn't just apply to individual homeowners, it also applies to commercial insurance lines, and condo and townhome buildings buy their coverage as a commercial policy through what's called a master policy for the whole building. So this law was written specifically to also cover condo associations, not just single-family homes. Now, the law gives you transparency. It does not force an insurance company to actually lower your premium, and it doesn't force them to offer you coverage at all if they've decided your area is too risky. So it helps you understand the number. It doesn't guarantee the number gets smaller.
Here's where it gets more complicated, and this is really the core of why condos specifically are getting stuck. Back in March, Fannie Mae and Freddie Mac put out new rules for condo buildings. A few of the big changes: the most a condo association's insurance deductible can be per unit is now capped at $50,000. The building's master insurance policy has to cover the full cost of rebuilding the whole property, not a discounted or depreciated value. And for a lot of smaller, older condo buildings that used to get an easier, faster review process from lenders, that shortcut is going away. Starting in August, every condo project gets the full, detailed underwriting review. Why does that matter for wildfire specifically? Because if a condo association can't find an insurer willing to write a policy that meets those new coverage requirements, or if the only coverage they can get has a deductible or a price tag that doesn't fit the rules, the whole building can get flagged as ineligible for a conventional loan. Buyers in that building can't get a normal mortgage anymore. Their options shrink down to cash buyers or a small number of lenders willing to hold the loan themselves instead of selling it. And when your buyer pool shrinks that much, prices usually follow it down.
So what does this actually look like on the ground? Insurance brokers who work with condo associations in mountain towns like Steamboat Springs, the area around Aspen, and Crested Butte have said something interesting. A couple of years ago, when Colorado had 2 relatively quiet wildfire seasons in a row, it actually got a little easier to find full insurance coverage for these buildings. But now, with fires actively burning again this summer, carriers are pulling back and reinstating the same restrictions that made coverage so hard to find before. For a condo owner, that can mean 2 very different problems. If the building's master policy renewal comes back too expensive, that cost usually gets passed down to owners through what's called a special assessment, basically a one-time bill that can run into the thousands of dollars per unit. And if the building simply can't find a policy that meets the new federal lending standards at all, it's not just a cost problem anymore. It's a can this unit even get sold with a normal mortgage problem. That's the piece that's different about this moment. It's not just premiums going up, it's entire buildings potentially losing access to conventional financing altogether.
As of today, July 19th, 2026, here's where things stand. The wildfire risk disclosure law is active, but it's brand new, so most homeowners haven't gone through the appeal process yet. The stricter Fannie Mae and Freddie Mac condo rules are phasing in over the next few months, with the toughest changes landing in August, and an even bigger reserve fund requirement not kicking in until January of 2027. So realistically, the full weight of this hasn't even hit yet. Condo associations are being encouraged to check their eligibility status with Fannie Mae and Freddie Mac now, before their building shows up on a lender's ineligible list without anyone on the board realizing it happened.
So to sum up what's actually going on, Colorado's wildfire seasons keep getting more intense. Insurance companies keep pulling back or raising prices in response. A new state law is trying to make that process more transparent. And at the exact same time, the 2 biggest backers of U.S. mortgages just made it harder for condo buildings to qualify for financing if their insurance doesn't measure up. Put those pieces together and you get buildings, especially in Colorado's mountain communities, where owners can't sell to a normal buyer anymore simply because the insurance policy on the building doesn't check the right boxes. If this was helpful, subscribe for the next update, because the next major deadline hits in August, and I'll be breaking down exactly what changes when it does.